This is the MTPredictor weekly market update for February 24th. All right, I'm looking at the weekly chart of the S&P here, and you can see prior we had a wave 5 high there. The market did correct there, and then went on and made new highs. Now if I kind of scrunch this up, you'll see these resistance areas here come from these prior swings back in 2007 and 2008. And you can see once we hit this wave 5 up was in conjunction with a major decision point resistance area off of this prior swing high here, and market corrected. So we're in that same kind of situation here, though we don't have a 5-wave pattern up here. We've taken that out. We just have basically an ABC with the typical wave C just a bit higher, right around that 1535, 1534 35, 36 area. But this is this next level decision point off the weekly chart from this swing high. This last high, which was the top back in 2007, that will produce a decision point up here, which is around that 1650, 1660 we'll call it, is the beginning of that resistance area. So you can see where we've got some major levels of resistance. We're in one now. We've got one higher there, and so this is why we're keeping an eye on the market. We're, in a cautious mode here because of the potential for correction. As we've seen last time we came up into this area, we've got a correction on the weekly chart. Doesn't look like much, but it's much bigger when you look in perspective from the daily chart. So we're in that area now. We've talked about this, and that's why we said it's a critical area for the market. If it can get through this area to the upside, then we've got a lot of room to the upside ahead. If it fails, or typically we can get a correction in here as well, and they can come back and retest this area. But we're in an area where we anticipate that the market could correct in here. If they just take this thing out to the upside, as we see, I'm watching the on balance volume here to see if we get any divergence. We haven't had any. We got a new high in price. We got a new high in the OBV, and so that's confirming we don't have any divergence there. So again, you still have to be cautious if you're long, whether it's your 401k or whatever, anything you're in that's geared to make money only when the market goes up. You got to protect those positions at this point because a correction could come. And again, the Dow, same position. Here's the weekly chart. You see those resistance areas. There's that line in the sands, the 14,000 level, and I give it that 14,000 to 14,100 is the resistance area. We don't have, interestingly, we had a succession of new highs here in the Dow. You look at these three or these two successive highs after this particular high here. If we look at the oscillator here, we don't have what we call double negative divergence here. We've got a new oscillator is higher here than it was back here, so we don't have that kind of double divergence that sometimes you'll see at market tops and stuff. So it doesn't mean that we can't correct from here, because again, we do anticipate that is a high probability, or at least a good probability. If they work their way through that 14,100, the ES works its way through its level, then we've got a lot of room to the upside. This decision point off of the highs back in 2007 in the YM and in the Dow puts you around in the futures contract around 14,750 would be the beginning of the resistance area there. Now the NQ is the kind of the problem child, because it's diverging from the other markets from the sense that we have or it has not been able to take out. So in other words, it made its 5-wave pattern up here. It's corrected. It's rallied into what now could potentially be wave 2. And that's the problem that we talked about, is if it failed to make a new high, whereas the S&P and the and the Dow have gone on to make new highs, above this their wave 5 highs. The NQ has failed, and it has still, let me just clear this off, it has still not been able to get out of this. I'm going to put the wave 2 resistance area. It's just traded above there, but it hasn't been able to close above this area. And so the danger is, again, we could at least go wave C down, and I'll project that down here. So we could at least go down back below 2500, or worst case, this did unfold as an ABC correction on the daily chart, this leg here, and so a potential holy grail would mean wave 3, and this would be the kind of worst case scenario down to the typical wave 3, down around 2200. Again, we're talking about the weekly chart here. So again, we continue to keep our eye on that. Some other things that we'll start to look at as well. I'm just going to bring in the weekly chart of the VIX here, the Volatility Index. And you can see, going back over time here, back into 2004, 2005, 2006, 2007, that VIX sat, below, right on that 14 area. And then when, obviously, it broke out of that area and we had this peak here in volatility. This was basically your crash in 2008. And now you see we've settled back in below, around that 14 level. And we can stay down here for, we can bounce around here just like we did for a few years here. But because we're in this level, we're in a kind of support area, if you will, in terms of the VIX, and so we could see spikes like we've seen. These are some, the spikes have gotten a little bigger than before the crash of 2008. We had, but they've increased, and so we could be getting, or we could anticipate potential for these spikes here. Now that we're in this low volatility period, we could see periods of increased volatility. So we'll keep an eye on that. Okay, let's well, I've got this up. This is oil here, and we've been tracking the weekly long in oil there. This hit the 200 period moving average basically. This is the continuous contract, but so you could have stops to break even there if you were long oil. Hasn't been able to reach the target there right around 102, but made some good progress there up to just around that $98 high of 98.83 there. So just shy of the $100 level, but you can see if we do come back down here, I'll give you a couple of support areas to look at. This decision point off of the prior swing low there, around that $84 level, and then these levels back here, right around that, we talk about that $80 level being some major support, and especially if they get down just below that to the $78 level, there will be some major support there in oil. We've seen this; they haven't been able to actually break that $80 level in quite some time. So we'll see if this, anticipate some type of pullback here. Don't have any. I'm just looking to see if little minor pattern here. So maybe find some support in here. We'll see if it can rally or consolidate in this area, make one last run up into the target. If not, if this area gets taken out, chances are you get stopped at break even at that point. But let's take a look at gold here. And gold obviously has been getting hammered, silver too. Again, we look in context of our, let me see if this has got enough data on it here. No. Let's again, this is the continuous contract. Put some data on there. just for some perspective. So you can see, going back basically to 9/11, the bull market, we had the golden cross there with the 50 period, the red line crossing above the 200 period, and that started kind of the bull market. And you see we've had new highs in gold every single year with the exception of 2012. All right, and that, I think you can see, gold, you know, does fall into these periods of extended consolidation. This is, you know, not new, and it can last for months. And here was the crash of 2008. But all these all these consolidations and these pullbacks below the 50 period, you see the nice buy signals here on the weekly chart, have all been, you know, good buying opportunities. So I think when we failed to make that new high in 2012, maybe we're in a period of consolidation, and you can see this kind of triangle that's forming. Gold has reached kind of the bottom of that triangle. We'll see if this support level holds. If it does break down there, we may visit the 200 period moving average. It wouldn't surprise me. But the key thing here is, I know there's people that are selling gold now because the market is going up, and they're saying, okay, well, there's really no need to hold gold now because the market is fine. The market has gone up. But really not understanding the reason why you want to be holding gold is not because the market is going up or down. It's because the reasons behind the market going up, in this case, is the intervention, you know, by the central banks really around the world, trying to stave off this deflation, and you know, and really trying to inflate things. And so the market is one of these things that's being inflated, and that's why you want to be owning gold. And you know, long term, I'm talking buying these pullbacks and stuff. You know, there are other strategies to take advantage, and we have done so, taking advantage of some of these strategies for swing trades and things like that. But I'm talking about, you know, longer position trades and holding gold for the reason against you know, inflation. And then something that you can kind of track, I'll pull in, and this is courtesy of the crystalbull.com, but they had a very nice chart that tracks, obviously you see the S&P 500 at the top here, but something that you can watch is capacity utilization. And what we want to watch here is for it using the capacity utilization as a leading indicator to potential high interest rates. And what we see, if you look at the bottom of the chart here, when capacity utilization gets above 85, in the high periods of high inflation, we have to go back to the 70s and 80s here. But when the capacity utilization, you know, we have all this money printing. We know that around the world, the central banks are you know, debasing their currencies, printing this fiat currency. We know that's happening, but we're not really seeing, you know, it's not very evident of the people argue about, you know, whether we have inflation or not, and you see inflation in some things and not in others. But when we're talking this, we'll use the proxy for inflation as a consumer price index. But we have all this kindling out there, this fiat currency, all this money printing around the world, but we don't have any fire. Nothing, no catalyst has set. We're not seeing, you know, inflation or hyperinflation and all these things that would really force gold and silver higher to account for that. So one of the things that we can watch is this capacity utilization. When it breaches the 85 level, as it did here back in 1972, you can see interest rates were pretty low. They were 2 or 3%, as evidenced by the CPI here. But you see, once the capacity utilization breached that 85, we saw interest rates begin to move higher. And again, it preceded the move in the CPI and interest rates to over 12% by 1974. Right. Again, we saw in 1978 we began to breach that 85 level in capacity utilization. So in other words, this tells us the velocity of money speeding up this capacity utilization, and that's kind of the spark that lights the fire on interest rates. And then you can see the interest rates again were low in that period, 1978, around 6% or so, and then by this capacity utilization giving that kind of heads up that higher interest rates were coming, by 1980 the interest rates were over 14%. Right, so you can see if we go to the right hand side of the chart here, you see the capacity utilization here is below 80. All right, so in interest rates you can see the interest rates have come down. Of course, a lot of this is your Fed purchasing bonds, keeping the interest rates artificially low. But watch that capacity utilization. If that's something that does breach, now it's got to take out 85 and hold above that 85 level. And when it does, that's going to be a heads up that interest rates may begin to move higher. So I'll just leave you with that in terms of what we're looking at here, kind of adding that to our gold analysis, if you will. Silver, and I don't want to take too much more time. Just looking at silver here. Okay, silver, I may look to buy more silver if it does get down to the bottom of the triangle in its 200 period here. And so somewhere around that, we'll call this, what is that, 26 and change, similar to these areas that was a low back on this period, 26.30 area. Be looking at that area. If it gets down there, we'll see. But you can see the kind of descending triangle here in silver. Again, a period, as you see that's consolidating, maybe this monthly or many month-long consolidation that may be happening here. But it's narrowing, that channel is narrowing, and then we may see the break one way or the other here. We'll see. So anyway, I've gone a little bit over than what I wanted to do, but again, I had a lot of stuff to cover. We'll be back at it next week, and we'll kind of see how things play out. But watch the, again, in these levels in the S&P and the Dow, that typically we would anticipate corrections. If they can power through those areas, then there's we got some room up ahead to the upside. So we'll see how that plays out. All right, have a good week, and we'll see you back next week.